Welcome back to Next Gen Investing. Today I'm going to teach you how to make a consistent income in the stock market. The strategy that I will be teaching you today will allow you to make money in any kind of market, whether that be a bull market, bear market, or a stagnant market. This strategy will not make you a millionaire overnight, but it will also not make your balance disappear overnight like many risky strategies do. Instead, I will show you how to slowly and steadily increase your portfolio using a strategy commonly known as covered calls. To get started with this strategy, you'll first need to make sure that your broker allows you to trade options and that you are approved to trade options, which in this strategy will require level 1 options trading ability. The broker I'll be using in this video is Robinhood. Options allow a person to greatly increase the return on investment due to the fact that, unlike stocks, options have an expiration date. However, options can also become worthless and decrease in value much more quickly than normal stock. Once you have options enabled on your account, you're ready to begin. To begin this strategy, you'll need to already own at least 100 shares of a stock that you want to use this strategy on. In this video, I'll be using 100 shares of Robinhood stock. You may use this strategy on any stock that has options, including index tracking ETF, but be aware that the more stable a stock is, the less money you're likely to make month to month. Stocks that are relatively stable, which typically are high-value stocks that pay large dividends, or are ETFs that track indices or a large number of stocks, have cheaper options because the expected move on the stock isn't that high. I will be demonstrating this strategy using Robinhood stock because it is pretty volatile and the option prices, also known as the premiums, are quite high at the moment. So once you've found the stock that you want to sell your covered calls on and you have 100 shares of it, you're going to want to go ahead and open up the options chain for that stock. So I'll click this button here to see the options. As you can see here, there are call contracts right here, as well as put contracts. A call contract, if you buy it, it typically means that you're bullish on a stock. And if you buy a put contract, it means you're bearish on a stock. The risky thing about options is that they expire, which means your contract could be worthless even if the stock is not. So as you can see here, these option contracts expire on August 27th. So let's say you bought a $50 option contract and Robinhood expiration date is $47.50 or whatever. Your option contract for $50 will expire worthless because it's not in the money, which means that the stock price is not above $50. And since this is a call contract, that's what you want. So this will expire worthless. So as a buyer, this is not a good strategy. However, as an option seller, which is what this strategy is going to teach you, you want your option to be worthless on expiration date for the maximum gain. So as an option seller, we like to sell options that have a high premium because that means more money in our pocket. So for this strategy, we will be looking for option contracts that expire approximately 45 days from now, as this expiration typically gives you the best premiums for the time on the contract. So for this video, we're going to be looking for the October 1st contracts because that's the closest to 45 days that we can get. Obviously, you're not going to be able to get it 45 days right on the dot every single time, but the general rule of thumb is to find a contract that expires greater than 30 days or less than 60 days. And 45 days is definitely the sweet spot here. So today is August 24th, and these option contracts expire on October 1st, which is 38 days away, which is the closest that we can get to 45 days, as the next expiration is an extra 14 days after this one. So now that you've found the best expiration date, you then want to find the best option to sell, which is typically the option with around a 30 delta. Some brokers will display this as a 30 or a 0.3. So we can click on the $48 contract here and you can see that it has a delta of 0.542. So Robinhood displays it as 0.542 here. Some brokers may display it as 54.26 or something like that. So the delta number simply represents how much the option price will change for every dollar move in the stock price. So right now, Robinhood is trading for $47.93. Now, if the stock goes down to $46.93, then this option contract, which is worth approximately $4.30, will go down approximately 54 cents right here. So it'll be worth somewhere around the ballpark of $3.80. So the 30 delta call usually gives you the most amount of premium for the least amount of risk. But if you want to be less risky, you can always sell a lower delta call. But keep in mind that the premium you receive for selling the call will be lower. So we're going to scroll up here to find a 30 delta call. Let's see, the 52 has a 41 delta, so we want to go up even more. Let's look at the 55 here. So here we are getting closer to the 30 delta option. 56 here looks like it has around a 31 delta. 57 has about a 29. So we're going to be looking at selling the $56 call contract. So as you can see here, this is going to net us around $2.18. This is the mid price, so it's not a guarantee that you'll get filled here, but people are bidding $2.05, so that's the least you'll get if you sell it right now. So what you want to keep in mind when you're selling this call contract is that you're giving the right to the buyer to buy your 100 shares for $56 by the expiration date. So they can either buy the shares anytime and up until the expiration date, and then once the contract expires, they no longer have the right to buy the shares. So keep in mind that if you sell this call contract, you are telling the option buyer that you will sell them your 100 shares of stock for this strike price, which is $56 per share. In return for selling this contract, you will be given $220 approximately by the option buyer. So $2.20 here per share, which 100 shares in the option contract, so in total you'll receive approximately $220. So now that you found the right call contract to sell, you're going to want to go ahead and sell it. So make sure you're in the sell mode for the call and go ahead and select it. Now that I have it loaded here, you can see Robinhood is showing me an expected profit and loss chart. So you can see here that if Robinhood goes above $58.20, which is $2.20 higher than your $56 strike price, which would be your break even, you'll start not making as much money. So it does show here that you lose money, but in all reality, you are not losing money, you're just not gaining that extra money from the extra rise in the stock price. So you have to make sure that when you're selling this call contract, you're actually willing to sell your shares at $56. If you're not willing to sell it, then you should look at a lower delta call. Say the 60 you see here has a 23 delta, and you get less premium, but it also means that the stock price has to go up that much more just for you to have to sell your shares. So now all we have left to do is to actually sell this call contract. So here we'll go ahead and click continue, and we'll enter that we want to sell one contract. The limit price, we'll set it at $2.20, which is the mid price between the bid and the ask right here, and hopefully we get a fill here. And when you sell this, make sure that it says that you're getting a credit, because that means that you're selling the call contract. If it says debit, then that means you're buying it and you've messed up here. You need to make sure that you are selling it instead of buying it. And make sure that you realize that when you are selling this, you're agreeing to sell your 100 shares at the strike price that you selected on or before the expiration date, because the option buyer has the right to exercise their option anytime between now and the date of expiration. So we'll go ahead and send this order out and hopefully we get a fill. So unfortunately the stock price has gone down a little bit, so I'm just going to replace my order so that I can get filled here. Set it down to 210. I think that's okay. Actually, I'll change it to 215 and see if anyone will buy it. Alrighty, and there we go. It appears I've been filled on my call contract for $215. So the covered call strategy is best used when you're not extremely bullish on a stock. If you are extremely bullish on a stock, you shouldn't be selling covered calls, because you may end up losing out on a lot of potential gains from your underlying shares. As I showed earlier in the video, if you sell the 56 strike here, and let's say Robinhood goes up to $90 or something, because that has happened in the past where they had a huge increase. It went up to $70, so you can miss out on a lot of potential gains if you sell a covered call, say at $60 or so, and if you had gotten your shares called away, you would have lost out on an extra $1,000 because you sold at $60. So just be aware of that. Also make sure you're aware of when the underlying stock company is planning on releasing earnings, as stocks typically move substantially during that time. So the options premiums will be much higher during that time, but that's to account for the fact that it's expected that the stocks will move in either direction pretty greatly when the earnings come out. So make sure that you're aware of that. Thanks for watching the video. I hope I have helped you learn how to make more money from the stock market. If you have any questions or feedback, please be sure to leave a comment below. And if you like the video or appreciate what I'm doing, please be sure to show your support by liking the video and subscribing to my channel for more videos like this in the future.